particular short-term course. Today we will be dealing with the ESOPs and the applicability more in the listed companies. And we have with us a learned faculty, Shri Vivek Sadhale, who's founder partner of Legal Logic law firm. Vivek has 24 years of rich experience in numerous fields: international technology, commercial contracts, successful IPOs, top tier venture capital investment, private equity funds, M&A takeovers, joint venture agreements, managing investor relations, and he has worked with various multinational companies across, and he has extensively worked on negotiating and international commercial contracts especially, and done a lot of work even as a for M&A, PE, VC deals, and he has also worked with Persistent Systems Limited for more than 13 years and headed as a company secretary and legal and investor relations. Vivek has flair of teaching and writing, and he has contributed various articles in various international journals, and he was ranked sixth in the as an investor relations professional in India by Thomson Reuters in the year 2011, and he received several awards. He is a fellow member of our institute and an associate member of the Cost and Works Accountants of the Institute. Welcome, Vivek sir, for this session. And the moderator of this session, Mr. Biman Devnath, will be joining soon. It's a little late, so we plan to start directly to save the precious time of all the participants who have joined. Thank you so much, sir. It's over to you, Vivek sir.
Thank you so much, and good morning to all of you. It's always a pleasure to speak at any event which is organized by the Institute. I owe a lot to the Institute, and so thank you so much one more time. Devendra, for inviting me, and to those who are hosting this, gratitude to all of you. I know how tough it is, and I know how you are working overtime to make all of these things happen. I understand there are ladies who are helping make this happen. Banu Madam, Khan Madam, thank you so much for all your work and late nights that you're putting in to put this together. And obviously to all the participants who are using this opportunity to do learning and essentially are helping the whole community at large to disseminate the overall knowledge as you will look at. What I intend to do in next 90 minutes or so is to take you through my learnings on ESOP as I have practiced both at the time while I was in employment and now as we practice the profession. And there are certain nuances which are very important and useful for all of us to understand. And we could make a decent amount of practice as someone who's in practice, and someone who is in the company as an employee obviously can help the management in terms of getting to the next stage. Obviously, ESOP has been spoken at various forums and at various events. What I intend to do is to talk more on the practical side of it, and obviously the regulation side of it I'll cover at the back end of the presentation, just to make sure that everyone understands and gets deeper insights into what the whole thing is. Khan Madam, I'm trying to share this file. Let me see if I can do it. I got. Can you help me with the? Yeah. Okay. There you go. All right. Is this visible?
Yes, sir.
All right. Okay. So this is what I'm intending to present, and in these negative times with what's happening at the stock market and what's happening overall, anything when someone says is money is most welcome. I'm sure as a new email hits your inbox with someone asking for some help, advice, obviously, everyone gets energized to see anything new coming their way, and that's so true for everyone, including me. And this was not the case 6 weeks back, and I'm sure this will not be the case 6 weeks hence. And this is therefore a beautiful time for us to reflect back in terms of how fragile everything is. And ESOP is no different than that. It's very fragile. You never know whether you will make money or not, but you still need it. Okay. That's like, your first love, your ability to know as to what works, what does not work. And you continue to assume that, you are wanting it as much as you desire it to make money for you. And that's exactly what the ESOP does, and it has done for multiple different companies. We've heard a lot of good stories, and we have learned a lot of bad stories on ESOP as well. And it remains paper till the time you see money in your bank. It is nothing else but a piece of paper, but that piece of paper could be this picture as your employer provides it to you if you are an employee, and if you are a director as well. And we'll see as to who is eligible, who is not from the Indian context. I must say that this is not uh, a legal advice. This is more on the academic side. So please take it from that spirit, and I'll be very happy to answer all the questions as we take it at the end of the presentation. Uh, Usually my style of presentation is to use as less as the slides as possible, but given the fact that we are all doing this online, I thought I'll use the presentation so that we are all focused, and then we can navigate this pretty well. Having said that, I want to keep it as interactive as possible. I know most of you know about this topic. I'm going to only help decipher a little more as to what the practical side of it and what my experience is, and we'll see how it goes. And I will reserve more time for the question and answer. And I'm told someone is going to moderate this particular session, and will throw the questions as they come. And I'll also see in the panel when time permits. So with this, thank you once again for inviting me. And here you go on the ESOP presentation. Uh, you've heard a lot of people talk about a lot of things, and there is a human brain, and the human brain, which is what continues to work, is always asking for more. Okay, they'll mange more, and the brain, of course, demands more. And when you become a professional, you expect more things to look at. And that's what this ESOP is all about. Employees all the time are looking for motivation, and the talent has to be attracted and retained through appropriate long-term rewards. Remember that there are two sides of the coin, and there are two sides of a financial instrument of any company that you see. There's a balance sheet that starts in India on 1st of April. Most of the companies start on 1st of April, but there is a balance sheet which continues to build over a period of time. What I mean by a P&L and a balance sheet is not a simpliciter as to what we have learned in our books, but it goes in a little bit of a philosophical way, where what you do builds the balance sheet on a daily basis. But what you do is something which hits your P&L on a transactional basis. So if you were to look at the difference between a compensation that comes to an employee, which goes and hits the P&L, which is an expense for the company, income for the employee, ESOP is building value over a period of time. Okay, it's the brain function which helps build value over a period of time. What is balance sheet? Balance sheet is not just a period item, but it's over the period what gets accumulated. It could be profits, it could be losses, it could be reserves, it could be negative reserve. All of that is sum total of what you have achieved over a period of time. And that over a period of time depends on whether you are an IBM, which is a 100-plus-year-old company, versus someone who's a startup, which is under a year-old company. But everyone is trying to build a balance sheet, and that's what gives strength. In this COVID times, what is helping companies is what is their balance sheet strength. And that's exactly what this ESOP is all about. What people do while they're giving ESOP is not just remunerating a person to help run the P&L, but actually helping build the balance sheet. And that's a major difference in terms of when you look at what is a cash compensation that everyone gets for the work that they do versus ESOP as a tool, as a reward tool, a long-term retention tool that a person is given to effectively build the balance sheet of the company, build the value for the company. Remember, what is the underlying security? The underlying security is the shares of the company, and those shares essentially is what determines the value of what will unfold as ESOPs. So what are we talking about? We are talking about something which is nothing but an option. It is an option, meaning the employee has an option to subscribe or not to subscribe on that particular instrument. But when it is issued, it becomes a liability or the responsibility of the company, and it's a legal liability under law, under company law, under SEBI law. You find that becomes a liability of the company, and then it becomes effectively an obligation on the books of the company. So while it is an option for the employee, which means he may choose or choose not to exercise that, and I'll explain what I mean by that, but it becomes an obligation, it becomes a liability on the books of the company as soon as it is issued under the company law, under the contract law, under the SEBI law, as you see it. And therefore, there are nuances of what this whole thing is. And remember that this is long-term in nature. This is balance sheet, which is long-term in nature, and therefore this has to be looked upon from all scenarios. Whenever something which is long-term in nature, you spend a little more time than what you would spend for a transaction item. And there are various ways of looking at what this ESOP is in terms of ownership, in terms of sharing wealth, in terms of creating a belonging to the company, in terms of invoking the entrepreneurial values and aligning the interest of the employees, employer, and the shareholders effectively. When everything goes aligned and all the four wheels of the vehicle or the two wheels of the vehicle are moving in the unidirection in the same way, you find that you will have a better measurement overall and better result as you look at. One of my first memory of the ESOP when I joined a software company way back in 2000 was about Infosys issuing ESOP, and a very successful program that they put in place, which resulted in even the and that was the in 2000, year 2000 is just 2 decades. Of course, there were ESOP before that, but something which became mainstream was about 2 decades back, and that's the time when my first encounter started with ESOP as well. And you have, as you've learned And as you have seen through the journey of ESOP in India, everyone remembers the drivers and the electricians. That's a beautiful way of remembering something that, gets imbibed in your memory all through in terms of what this ESOP created with overnight. Even in my party, when I was all those that's something that you will find people in terms of at this point in time, you will find that the ESOP is back in vogue and back in vogue with
Sadly, sir.
vengeance.
Yeah, you can unmute your video because your audio is not very clear.
Find
You
that
can-
post-COVID or during COVID,
Sir,
it's
Sadly, sir.
going to become a mainstream instrument in terms of how you retain talent when the cash is, really scarce. Everyone, including banks, including
Vivek sir,
yeah.
Vivek Sarle sir, you may mute your video for some time, sir. Yes, you may mute your video for some time, sir.
All right, give me a minute. Give me a minute.
Biman? Hello? Biman? Are you there?
Yes, Biman, you can speak.
Hello?
Biman?
Deepak ji, just request Sadly, sir to take the earlier slide again because people were not able to
Yeah.
hear that. So either you or Biman. Biman, I think he is not audible. I don't know why.
Biman, are you able to listen to us? Biman, you can unmute your video.
Yeah. I can hear you.
Yes, please unmute your video.
Yes.
Yeah, welcome, Biman.
Yeah. Good morning, all.
Welcome, Biman. So let me introduce friends, Mr. Biman Devnath, moderator for the program, secretary, EIRC of ICSI. Biman, we just started the program, and
Yes.
Mr. Vivek Sadale is the speaker for the day.
Yeah. Good morning. Good morning, Vivek.
Vivek is just rearranging the things,
Okay.
and shifting to the new internet. You
Yeah.
can see some requests from the participants. There was some
Yes.
voice break in between.
Yes.
And
Yes.
so when Vivek ji will join, you can request him to commence from the previous Infosys slide where he left and take up the program from there.
Okay. I'll do that.
Okay. Thank you.
Thank you, Deepak ji.
Yes, Vivek ji, Mr. Biman is here. He is the moderator.
Yeah. Vivek, good morning.
Good morning, Bimanji.
Vivek.
One second.
Yeah.
I have actually joined twice. Let me just close one of the.
Sir, you can just mute one. That is also fine.
Is this now visible? Hello?
No, Vivek, presentation has not come.
One second.
Yeah. Now it's there, Vivek.
All right. Okay. Can you see the presentation?
Yes, we can.
Yes.
All right. Okay. So what I was saying was this is the make or break time with the COVID coming in, and one of the things that is definitely going to happen with the cash as a constraint. ESOP is going to be back in business. It has started to show a lot of meat in last 3 years after being down and out, after certain accounting and the tax issues that the India Inc. faced. I'm going to talk about those as well. But remember that with COVID coming in and with cash going out, ESOP is going to be one of the instruments being used across the board, including the startup community, to make sure that they tide this particular situation with. And that's one of the reasons why this becomes a very important and critical aspect when you are dealing with your client in terms of suggesting what is the best approach to take and conserve cash as they go. Having said that, this has to be used judiciously. Remember that once it is given, it becomes your obligation as an employer, and therefore it has to be used judiciously and not randomly just because there is an event that you need to tide up to, and we'll speak about some of the practical aspect of it as we go forward. But that's exactly as I remember Infosys drivers and ESOP, and that's exactly what my remembrance is. Some of the surveys have gone and said that the ESOP companies have 25% higher rate of job growth, and that's like a staggering number. And remember, my view is that these numbers will continue to go up. I don't remember which survey was this and what date this is when I put this slide on, but we will see these numbers grow up in these COVID times. We're talking about derivatives of stock options, which is ESOP, which is stock option plan, which is what we all understand as a parlance. There is stock appreciation rights. There is RSU, which is restricted stock units, and there is employee stock purchase plan. So all of those effectively are nothing else but stock option variants, and that's all listed in your SEBI regulations as well, and we'll speak about it in greater detail. Remember that what plan to use when is extremely critical, and I'll give one example before I forget that, is what you call as a restricted stock unit. Now, one of the reasons why some of these terms which have come about is not because they are jargons, but because they are used to address a particular situation. What is that situation? That situation could be you are already public company, you are in a growth mode, and your growth is what determines your differentiator in the marketplace. With what the guidelines are in terms of the pricing and whatnot, you are in a situation where you are, effectively looking at if you are effectively looking at a plan where the dilution is less, and you continue to offer substantial money to those who are performing. And that's one of the reasons why some of these terms have come about, and we'll talk about it in greater detail as we go about on the RSUs and SARs specifically, because ESOP in ESPS is something that we all understand very well. And I'll come back to you on SAR and RSU in terms of when to use and how that's exactly used in the marketplace. One of the most critical questions that comes is how much do you offer to what level of people? And that's one question where there is no legal answer to it, which is great because that's where the human element comes into play, and that's where your ability to understand as to who deserves what is something which is important to understand. And remember that there are no rules as such. What you see on this particular slide is an indicative measure in terms of what are you trying to do. Remember, at the time when someone joins the company, what he is looking out for is cash in hand, and therefore you will find those who are at the bottom of the pyramid. As you see the pyramid, they are more motivated by cash, and for them ESOPs may not mean a huge thing, and I'm talking especially in the Indian context. As you go up the ladder and as you go in the middle ladder, you will find that the ESOP starts to find favor, and then you are at the top level. Obviously ESOP is what people would want to be associated with, and as they call as skin in the game is what people would expect to be rewarded with, apart from the cash compensation, and that becomes a big differentiator. So depending on what level you are looking at rewarding a particular person, you could look at this as a guiding factor in terms of your ESOP plan. How much should ESOP plan be in any company? What they talk about is that you should have at least a double digit, which is 10% and above, after your Series A funding is done. What do I mean by that? It means that you must make sure that after your Series A funding is done, your ESOP, whether granted or otherwise, should be at least 10% of the company. And if you are with that 10% of the company, you should be in a position to navigate your company to the IPO or to an exit, to a potential exit, which could be an M&A, pretty well. That's what the market talks about. In India, though, people, if you were to look at what is the normal norm, you will find that it is about 8 to 10% is what people leave ESOP with, which at times, after your Series A drops because of the dilution in the shareholding and the cap table to about 6 to 7%, which may or may not be adequate as the company grows. Remember that you are not offering ESOP at one go to all employees. You are keeping a war chest of those ESOPs to be awarded at a later point in time. And that's exactly why the investors would expect you to have a double digit in terms of your shareholding in the ESOP program after the Series A is done. And that's something that is very, very important as you build your share cap table as a growth oriented company. So when do you give ESOPs? So when you give ESOPs when you are on a threshold of growth. A very, very new company, you're a startup, you are just under 1 year old as a company, and you're trying to give ESOPs, it may or may not carry as much value as it would after you have started to see revenues starting to come to your company and you're starting to see something which is a growth which is associated with the company. And then once the growth story is reasonably certain, and therefore you are able to see possibility of an exit, which is what we call as a liquidity event, and that time the stock options start to become very, very successful. Because as I mentioned earlier, it is just a piece of paper. A person who has been granted those ESOPs must understand that there is always a possibility of that being encashed, and therefore when someone is on the growth path and there is an exit and liquidity possible, at that time this becomes extremely attractive, and therefore those who are on a threshold of growth would stand a better chance of getting these stock options into their pocket, and they would value them far more than someone where it's just a start, or someone who's not making profits and is not growing assets. So that's something which is very important to remember in terms of looking at ESOP. And of course, because you have ESOPs and when you have motivated employees, you're looking at 25% more likely to stay in business. And that's one of the reasons why I say that in these times you will find that this instrument being used effectively in terms of retaining employees, as well as making sure that the business continues to be solvent and you are in business, as they say, going forward. This is where now the technical presentation starts, and I'm going to talk about what are the terms that we must know when it comes to ESOP. And these are the three most important terms, and please be with me in terms of understanding as to what these three terms mean. The first is grant, and then it's vesting, and then it's exercise. And I'm going to tell you what exactly all of these three things mean. The grant is the English word of someone giving an option, which is the company giving the option to an eligible employee. That employee gets a letter by the company under the ESOP plan, which is billed by the company, providing the detail of what has been granted in terms of the number, the grant date, and the grant price, the price at which it has been granted. Remember that the SEBI plan as well as the law allows complete freedom to the company to give the price at which it wants to grant the options. And that's a very important tool in the hands of the company to reward the employees. And therefore, you will find that most of the companies give discount to the fair market value at the time when they are issuing these ESOPs, especially when they are a pre-IPO company. The important understanding is that you want your employees to make money, you want them to actually become successful, and for it to happen, the pricing becomes extremely critical. So what are you trying to do? You are trying to make sure that the grant is given at a price which is attractive enough for the employees to feel motivated that they're going to make money. And therefore, for example, if your fair market value is 100, you might want to give the ESOP at 50 rupees so that the person is in money immediately when it is granted. Remember that it doesn't become his own asset unless the next two stages are met. And the next stage after grant is vesting. The vesting is a process by which the granted option become the asset of the employee. The law requires in India that the vesting period is minimum 1 year, which means that you cannot grant something and vest those options immediately. There has to be at least 12-month period that needs to go between the grant and vesting. That's a very, very important aspect of ESOP program, that you can't grant something and they immediately vest. In India, it can't happen, and therefore the vesting, at least 12-month period is what is expected. Suppose, to give you an example, you grant someone 100 options, and then you say that the vesting period of those is linked on time basis, where in 4 years all those options will vest. And you have again freedom to decide as to whether there will be a linear way of vesting, which is 25% each year in the next 4 years, or if your vesting plan is 3 years, 1/3 options will vest each year. Or you may say that 10% vest in the first year, 20% in the next year, 30% in the next year, and 40% at the end of 4th year. So all those, there is a complete freedom, as is for the pricing. It is a freedom at the time of vesting as well in terms of what the plan could provide for. In India, usually these plans are 4-year plans with a uniform vesting. Whereas in the US, it's a 5-year plan usually, where the vesting could be on a monthly basis as well, and it could be an even vesting, or it could be a back-ended vesting, as I mentioned, 10, 20, 30, 40%, which is what is called as a back-ended vesting. A linear vesting is when everything vests at a linear level, at the same level, and then you could have a variation of all of these things. But the statutory limitation is that after the grant, 12 months need to pass before a vesting can happen. And remember that you cannot do a backdating of ESOP. It's considered as a criminal offense, because it's money and you're playing with money. And there have been several cases, not so much in India, but in the US, where people have been taken to task and criminally prosecuted for backdating on the ESOP, and that's not something that is something which is allowed. The first step, as I said, is grant. Second step, as I mentioned, is vesting. And then what is vested can be exercised by the employee. Remember, what is granted vest over a period of time, and what is vested can be exercised by the employee. And then I go back to my slide in terms of what are the various type of options, and there comes the beauty of what these options are. And let's now look at what does exercise mean, and then therefore what are the variations of this particular plan. When you're talking about pure stock option plan, it means that you need to pay the price. You need to pay the price of what has been granted. At that price, you exercise these options. For example, if you are granted 100 options at a price of 100 rupees each, that means you need to pay 10,000 rupees plus tax. I'll explain the tax concept in later slide, but you need to pay two things. One is the price at which you are exercising, plus you are going to pay tax for those vested options to become your asset. Very important concept. Grant becomes vesting, vesting becomes exercise. Exercise is something that you will do when you find that you are making money. At times, if the company is not doing well and the price, the fair market price of the option is less than the price at which it has been issued, what we call as an underwater option, you will not exercise it because you don't want to buy something which is in losses. And therefore, this instrument is called option, option at the hands of the employee and not at the option of the employer. Once employer gives, it becomes his obligation. And that's very important and critical to understand. In terms of the four different variations that I'm talking about, ESOP, as I mentioned, is a pure play plan where you pay the money, buy the shares. Is the same thing more or less on the ESPS. On the SARS, what you do is it is effectively a stock appreciation rights, which means that if the company is doing good and you are pegging your value of the options based on what is the value of your company is, then number of stock appreciation rights you have received could convert into number of shares, or you could get cash, what we call as a phantom ESOP. You could get cash as a difference between the price at which you exercise and the price at which it has been granted. So the difference between the fair market price and the price at which you purchase, subject to tax, becomes your gain in terms of the stock appreciation right when it is a cash-based stock appreciation right, as against the share-based stock appreciation rights, which would get you shares and not cash. But if it is a cash-based one, what we call, in other words, phantom ESOP, that would give you cash in your hands. In terms of RSU, it is the same concept as what we have seen on grant, vesting, and exercise, but with a variation that it's a deep discount to the market price. Usually RSUs are given by listed companies, usually, not necessarily, but usually. A company like Wipro started this particular concept in India way back in time, and where they issued restricted stock units, which meant that the number that they issued was less, but the price at which it was issued was at a deep discount, virtually at a zero price. People would have paid 10 rupees face value, 1 rupee face value to buy those options, but they were not given a lot of options because the price, the market price of the stock of, say, Wipro or a Persistent or an Infosys RSU was running into 400s and 800 rupees, which meant that you are in money on the day that RSU is granted, and therefore very select people and very select number gets allocated as RSU when you build some of these plans in your company. So what is the difference between RSU and ESOPs? Simply put, is the pricing, which determines, because you are a listed company and you don't have too much of wherewithal of giving options to your employees, because it's expensive to buy these options and create the pool if the pool already doesn't exist in the company, and therefore what you are trying to do is to give very small number to very select people, but at a price which is deep discount, which is what you do in terms of the grant under the RSUs. And that's the beauty of some of the variations of these particular plans. So ESOP effectively is nothing else but these three terms: granting, vesting, and exercise. If you understand and remember these three things, ESOP is effectively done. Obviously, there are other nuances that we will speak, but this is what is the real concept of ESOP. Under whatever variation that you talk about, either ESOP, either SAR, or RSU, or ESPS, all of them, you will find that you are effectively looking at, granting of options, vesting of option, and exercising of options. Usually, the plan would say that till the time the employee is till the time the employee is in the employment of the company, he could continue to exercise, or some of the plans have a particular time frame where the granted option is vested in the employee. He needs to exercise those, and the meaning of exercise is paying the price or opting to get the vested options as the asset in the hands of the employee. Okay, effectively he's paying that particular price, paying the tax, and exercising those options by purchasing those or telling the company that pay me the cash if it is a cashless ESOP, phantom ESOP as what we call that. So that's the difference between grant, vesting, and exercise. If you are clear with this, you are effectively clear with the overall concept of ESOP. And I'll take questions. I find a lot of questions coming in, and I'll take as we go forward. But that's very important concept on grant, vesting, and exercise. As I mentioned to you, grant price is the most critical aspect in terms of how you determine. The law gives you freedom. Our suggestion to clients has been that you should do not less than the face value of the stock. You could do it at book value. You could also do at the fair market value. Remember that the companies who have gone listed, most of them do at the fair market value or some discount to it, based on the based on what the philosophy of the compensation committee is. But essentially, there is a freedom to price your options so that the people are able to see the value. As I mentioned to you, you don't want to fully price the ESOP because it's a risk that an employee is taking to stay in the company to see some value associated with these options. But as I mentioned, the pricing is free. The pricing freedom has been given by law, and people can use it. The employers can use it, and you can advise the employers based on what the situation of the company is, so that it's a win-win situation for everyone. So what is when you design the stock option plan, and what is a person like you and me as professionals can do is to conceptualize this plan, consume the plan, and communicate the plan. All the three are extremely critical. Remember that the plan is as good as its communication to the employees. My learning has been that if the plan is very complicated, it does not go well. It has to be simple to understand, it has to be easy to consume, and it has to be communicated well for people to appreciate what it is all in it for them. In India, there is only 3 to 4% of the total population which deals in the share market. And this 4% is such a small number that many people, and I'm talking with all humility here, that many people do not understand and appreciate what the share is all about and what it could be the value, and therefore the communication part becomes extremely important. You might have a beautiful plan, but unless it is communicated well, unless you communicate over time, unless you are able to provide what is the growth happening in the company, unless you are keeping your employees updated on the yes and no of what the growth is all about, the plan may not be effective enough. And therefore, I continue to say that all of these three things are important. Remember that creating a plan is one-time exercise. Communicating is every day's exercise. When you hire someone and when you say that we have ESOP plan and we are going to give you ESOP, his ability to understand what is coming and what is not will depend on how you communicate that to them. Once you are able to do it, you should be in a position to make a win-win situation, that what you have conceptualized and consummated as such is communicated well effectively. And that's very, very important aspect of when you create this ESOP plan. Make sure that your communication plan is also created accordingly. So what are the decision points? What is the objective that you are looking at? Remember that the objective could be that I want to incentivize all my employees. That's what we call as a democratization of the ESOP plan. When you are small, you could have all people covered, but as you grow in numbers, your pie on the ESOP continues to be low and or reduce, rather, not low, reduce. And to that extent, at some point in time, you have to make the call as to, are you going to continue to reward everyone in the company, or you want to reward selective people and create eligibility criteria within the framework of what law allows you to. We will see what law allows, but this is an important element. First important thing, after you have decided as to what is the percentage of ESOP you are creating, what is and who is going to be eligible becomes very, very important as such. The other thing is that, what is the pricing? We have already seen that particular thing, but important aspect is that, what is it as your philosophy that you would want to communicate is something becomes extremely important when you create and when you start to conceptualize this particular plan. This is not an easy if and but answer. It takes time for people to get to the bottom of it, and it's always an evolving thing, and there are no right or wrong answers to this particular problem. And therefore, the suggestion is that a decent amount of research needs to go in terms of doing this. A good professional help is required to create this. But once you do that, you will have a super plan that will work for a long period of time. What is the dilution that you are looking at? What I mentioned about broad-based versus selective, democratization of the ESOP plan, everyone getting it versus selective people you're getting to the plan. Whether you are going to create a stock-based, which means you are going to issue shares, or you are going to give cash as the difference, what we call as a phantom option plan, cash as a difference as the reward, which is what many companies used to do. Not sure post-COVID people would be looking at phantom ESOP as their major way of looking at it. The other aspect that you decide while you put a plan together is vesting. As I mentioned, the vesting could be back-ended, it could be linear, it could be front-ended, or whatever option that you have. We have now started to see that vesting is now being linked to performance. What does that mean? It means that you are looking at performance of the company, you're looking at performance of the individual, you're looking at combination of performance of the company and individual to tag as to whether the options will vest or not. All that it tries to do is to make an alignment between the value creator and the value creation. If the value creator, which is the employee, is able to create the value, which is what we call as milestone, then everyone is creating a win-win situation. Remember that this is building balance sheet, and therefore rewarding for building balance sheet. and therefore has to be linked to value creation rather than only mere target achievements, which is a P&L impact. The P&L impact is paid for by way of a salary, by way of compensation, but creating the balance sheet gives you this particular effective tool in your hand when you create a vesting milestone that will be achieved over a period of 3 years, 4 years, thereby determining whether the person gets granted options will vest in that person, and therefore should he be able to exercise or he should not be able to exercise because they have not vested in him because he or she has not achieved the milestone as such. Legal structure plays an important part. If you are a holding company, then whether you are making a plan for the subsidiary company as well, or you are treating only the holding company employees eligible becomes an important part. If it's a wholly owned subsidiary, many a times and most of the times you will find that the subsidiary employees are also eligible for ESOPs. So companies like Microsoft, Qualcomm, Cisco in India would have granted ESOPs of their parent company for their employees in India. And that's something which what we have seen is the Indian companies granting options to their employees who are stationed outside of India or within India as subsidiary, knowing fully well that it's the structure created for some specific reason. And therefore, you are looking at creating these option plans for a holding company employee and the subsidiary employee. That becomes an important point as you plan for your ESOP. Whether the subsidiary is in India or not will determine whether foreign exchange regulation, FEMA regulations apply or not. I'm not going to spend too much of time on that because I'm told that the FEMA aspect are being covered or have been covered separately. The policy in relation to whether you want to grant on a yearly basis, half-yearly basis, quarterly basis, all of that is something that you could put under the plan or keep the flexibility with the board of directors or the compensation committee as the case may be. And you will put in your plan whether all the new joinees are eligible or they will be eligible after spending 2 years in the company, 1 year in the company, 3 years in the company, as what we call as filtering exercise, or you are creating a democratization plan where as soon as someone joins, he becomes eligible. All of those decisions are important to be made as you are building a ESOP plan from long-term standpoint. You are obviously looking at board resolution, compensation committee / shareholder resolution. You are doing a scheme documentation. You're putting an agreement in place with the employee and then creating a manual which is for the management of ESOP program. That's how you consume as the second C of my slide on this. We spoke about conceptualization. Consummation is effectively as to how do you implement this ESOP plan. That's by way of doing a board resolution. We'll talk about it in a while. It is about documentation. Again, we'll speak about it. The agreement part, some companies like to do a separate agreement with each of the individual employees while they grant ESOPs and then create a manual which is effectively a management of this ESOP, administration of this ESOP program. That becomes an important part in the overall scheme of things. The last C, before I take a pause, is about the communication. The communication, as I said, is the most important piece. Till you communicate, you have conceptualized and you have consummated the plan, but the employee gets the communication only after the first two things are done. When the first two things are done, the communication to the employee starts by way of the grant letter. That's the first time you are formally going to the employee, explaining him what the plan is all about by giving him the grant letter, providing him with the manual as well as the plan policy that provides him an understanding about what the whole scheme is all about. Afterwards, on an ongoing basis, as I mentioned to you, that communication would involve what has been the financial performance of the company, what is the future growth trajectory, what has been the stock performance of the similar companies in the segment that you are in, the industry that you function, and the stock option as a long-term instrument. What does that mean? And what is the money that an employee is expected to make without making any hard commitment, as giving examples in terms of how the market is moving with the growth that the company is making, what is the potential that the employee has in terms of making money. That communication every now and then, at least once in a quarter, if not more, is an important way of making sure that the employee stays put with what is his or her ability to understand what the ESOP means and how that will play out in the long run in terms of creating value. Let me pause and ask the moderator, do you want me to take questions so far, or should I continue my presentation?
No, sir, please continue. Right now, we can slot some time towards the end of the session.
All right, okay, I'll continue with that.
Yeah.
As professionals, one of the important things that you do, apart from conceptualizing and helping decide, is to draft the plan. And that's a very critical and important document in the overall ESOP program, because as I said, that this is a long term in nature, 3 to 4 years minimum or more, which therefore means that you have to think about all the possibilities. And in 3-4, we have seen what has happened now, and anything can happen. We are all mortals, and therefore you need to think about what happens to the company. What are the variables that we're talking about? We're talking about the company, we're talking about the individual, we're talking about the management, we're talking about the ecosystem. And you need to think all the probabilities that could happen. The employee may leave, the employee may be asked to leave, there may be death, there may be incapacitation, there may be company sale, there may be an IPO, there may be liquidation, there may be degrowth in the company, there may be combination of all of these things playing out, and therefore this is a highly what I call a complex problem that you will solve for your clients or for your management as you are putting together a plan which is going to run for a long period of time. And therefore, you must first break it down into meaningful questions. And once you start to get answers to those questions, you will be in a position to put a plan, a holistic plan in place which will last for a long period of time, okay, and which will test all the possibilities that it might. While while I was in employment and when we were running this particular program, in between, perquisite tax came into being. Okay, earlier till 2005 or 2006, I don't remember exactly, but during that time frame, there was no tax on the ESOP money that you made. And the government became very smart, and they put in place what you call as a perquisite tax, which meant that whatever gains you made earlier, they were without tax in the hands of the employee. Okay, which meant that whatever you exercised and you made cash or you made stock, you did not have to pay any tax on it. Post 2006 to 2005, 2006, you are looking at paying a perquisite tax, which is based on your marginal income tax rate. If you fall in the highest bracket, 30% plus or whatever that bracket is, you are paying perquisite tax on the difference or on the gains between the exercise price and the grant price. The gain on that is what you are paying tax on. When that tax came, obviously, that was not contemplated because tax was not part of the regime in the Indian tax system. But at that point in time, everyone who were running a ESOP plan had to create something which was, accounting for tax as such. Now with this COVID happening, you will find certain more clauses coming into play on the ESOP. And, therefore, as I say, that this is ever evolving, addressing the ecosystem as well. And therefore, this is a complex problem that you are solving. We've spoken about many of these things, but again, I'll, for the matter of completeness, make these few points which are important for you to look at. One of the questions that you will ask is whether you want to make a cashless scheme or you want to make it as a share purchase scheme. What is it that you are looking at? Or whether you want a hybrid scheme where the company has the option to stock out a person or cash out a person depending on what the plan is. Who all should be covered? Out of what the law allows you to, do you want to further filter or you want to cover all the employees being a democratic plan? That's something that you will answer before you start to draft. What is the vesting schedule? Is it linear, which is 25% each year for 4 years? Or it's a back-ended 10%, 20%, 30%, 40%, 40% at the last time? Or you are doing a heavy front-ending and then even over a period of time? All that is something that you could do. Or as I mentioned, you could have a milestone-based. The milestone could be individual milestone or company milestone, depending on how you would want to say. Some people would say, if the company, you are a CEO of the company, you've been granted options. If you overperform, which means that, your EBITDA percentage moves from 18% to 20% in a matter of 2 years, then you are, going to get a substantial vesting of your options, because that's your individual KRA, and that's the vesting schedule as to vesting milestone that you are looking at. Do you have what you call as a cliff, which is minimum service condition that you need to fulfill, that unless you have closed or unless you have completed 3 years in the company, you will not get ESOP, even though they have vested in you. You cannot exercise them. Some of those concepts from long-term retention standpoint is something that people put in. What should be exercise period? Are you wanting your employees till the time they are in employment to be able to exercise so that they don't need to pay any cash at this point in time when they are exercising? Or you are putting a period of say 3 years after the vesting to compulsorily exercise? Or are you saying that the exercise will happen only when there is a liquidity event and not before that? Liquidity event would mean either there is an impending IPO, there is a M&A event that is happening, or there is some funding event that is happening that leads to some liquidity, and only at that point in time you will allow exercise. There are certain cases where if you don't exercise ESOPs within the time frame that has been put in, the stock option will lapse. The stock option can lapse also when you are no more the employee of the company. Remember that the ESOP under the Companies Act now can be given only to the employees of the company and not to anyone else. There are different ways in rewarding not employees, but the ESOP, as the name suggests, is an employee stock option plan and therefore can only be given to employee. And therefore, the corollary of that is if you are no more the employee, whatever has not vested you that was granted will lapse because you are no more the employee. But you could have more terms that might result in lapse of the stock options. One of them is not exercising vested stock option within the time frame that has been given to you. In what cases stock option will automatically vest? That's a decision that you need to take. Would death result in accelerating stock options even though they are not vested? Remember that death is an involuntary separation, and the family, you might want the family to benefit, but some people say that we will allow only the vested options and not the unvested options to the family. Or if the person is incapacitated, he is in the manufacturing sector, he is working on a machine, and he suffers an accident, then how does the stock option work? All of those are important questions to answer. And obviously, while there is a perquisite tax, the law allows you to either recover it from the employee, or you could pay that particular tax on yourself as the employer. But that is something that you would want to expressly put in, or allow the board of directors to decide, or the compensation committee to decide from time to time. That's something which is very critical, and that's the learning that we had once the tax was introduced, in terms of how would you want to deal with tax. And then certain other things where the situation like COVID happens, and would you want to put something around those? Those are evolving thoughts that keep every one of us busy in terms of looking at it. What are the regulations that we are looking at? We are looking at Companies Act, we are looking at SEBI ESOP regulations, and I'm going to talk a little bit on that. And then we are looking at FEMA regulations. FEMA regulations, remember, are applicable on two occasions: when a company like Microsoft would give options to its employees in India, or a company like Persistent giving options to its employees in the US or UK or wherever. Okay, both times FEMA regulations will apply, and depending on which sector you are and what is the plan would determine what compliances are required to be made. The Companies Act gives now the eligibility of the definition, eligibility of who is allowed, and they have very clearly said that only the employees. Earlier to 2013 Act, those who were not employees were also being granted ESOPs. No more the case. The eligibility is very well defined. Of course, SEBI defines that clearly, but Companies Act also has created a framework where the only employees of the company and directors, I'll come to that in a while, are eligible to be granted ESOPs. So who can be given stock options? Employee in India or abroad, directors whether whole time or not, employee/director of a subsidiary in India or abroad of a holding company. They can be given options. Promoters or employees belonging to promoter group cannot be given options. They cannot be given options except under the Startup India scheme, where the promoters, those who are registered as startups, can also be granted ESOP, provided they continue to fall under the DIPP definition of startup. Okay, otherwise, if you're not a startup, then you will not be able to grant options to the promoter or the family members of the promoter group. Also, independent directors are not eligible for ESOP. Directors holding more than 10% equity, either directly through family or through any entity, they are also not eligible to ESOPs. Consultants, suppliers, vendors, associates, as I said, earlier they were, today they are not under the ESOP program because of the change in definition under the Companies Act 2013. It has made it very clear that only the employees are eligible to the ESOP, whether they are of the holding company or the subsidiary company. That's a different aspect altogether. Very important as you draft, very important as you advise, in terms of whether there are a lot of questions that come as to whether the advisors or consultants are eligible. Remember that there is a structuring that many people like to do in terms of being consultants for various reasons, including tax reasons. But the flip side of appointing someone as consultant, even though he is a full-time employee, he is like an employee, but is called as consultant and is treated as consultant, he may not be eligible for ESOP. So when you are looking at certain of these things, make sure that your employer or your client understands that the flip side of treating someone other than as employee might have consequence on his or her ability to get ESOP. Very important point. You could do ESOP in two ways. Directly, you could allot options and allot shares at the time when someone exercises those vested options, or create a ESOP trust, which is allowed under the Companies Act, under SEBI as well. And then what you do is you transfer certain number of shares in that trust, and the trust holds that in favor of the employee. And whenever the employee exercises the vested options, at that time, the trust would transfer from the ESOP trust to the employee such number of options which have vested in him, and he has paid the price to purchase that. It obviously has a lot of flexibility, but comes with a loaded administrative pressure. So depending on why you are creating one of the reason is if you are using a secondary route of creating ESOPs, which means that the promoters are putting in some shares under the kitty, or a certain existing shareholder is putting some shares under a plan in ESOP, then obviously you need to have an entity to hold it, and ESOP trust becomes important mechanism. But if you do not have a secondary mechanism and you are only using new shares, then at that point in time, you are obviously looking at, you could effectively look at a direct plan and avoid the administrative hassle. So evaluating whether to use a trust as a structure or going direct is an important criteria, building up on your, effectively maintenance of this particular entity and incurring expenses. It has the ramifications that needs to be understood as such. What are the rights of the stock option holders? They have the same, do they have same rights of the shareholders in terms of dividend, bonus, etc.? Remember that till you are the shareholder, you cannot vote on those shares, right? The voting is not allowed. In a private company, the trustees can vote, not in the listed companies, because in terms of the SEBI rules, the trustees are not allowed to vote on the shares that they hold as ESOPs, because they want the SEBI wants them to avoid the conflict, and therefore trustees are not allowed to vote under the ESOP plan. But as option holder, you're not eligible to receive any benefits as shareholders, except that if the bonus issuance or the corporate action happens. So there could be a bonus, there could be split. The benefit of that is automatically passed on to the employee indirectly, because the options are written by way of the security, by way of the shares, and therefore if something happens to those, which means there is a bonus issuance or a split of those shares, automatically that benefit passes on to the option holder, but none other, which is tangible benefit like the voting or the dividend as such. Remember, you cannot pledge, hypothecate, or transfer these options till they become shares. After they become shares, obviously you could deal with them the way you would want it. Remember, till the time they are options, they are not your asset, and till the time they are not your asset, you cannot deal with those. Once they become your asset, you have all the right to do what you do with your asset, so you could do it with the stock options as well. Tax on stock option, as I mentioned, this was included as perquisite tax under the finance bill, and then the tax is payable at the time when you exercise these options, as well as at the time when you are uh, selling the shares. Uh, of course, the price gets adjusted to the price at which the perquisite tax has been paid. So while there is some bit of duality at the price that you are paying, it may not be a dual tax as such. And what is the perquisite tax? The perquisite tax is nothing else but the fair market value on the date of exercise. Whatever is the fair market value, less the price at which you are issued those options. The difference between that is your gain, and on that gain you pay a perquisite tax, whether it is a cashless option or whether it is a share based option. Tax on startup, there has been some concession given to the startup employees by way of deferment of tax, in the current budget. And therefore, what has now happened is the tax that the employees would have had to pay immediately upon exercise has been deferred by way of 48 months, though this particular benefit has been given to those who are a startup under Section 80 1AC and not to all the startups as such. So there is a limited coverage there. While the intention is right, the coverage is going to be limited based on the ifs and buts which have come under the ESOP plan. ESOP accounting, in terms of the ESOP as such, there are guidelines being issued by the Institute of Chartered Accountants, and the ESOP accounting has to be based on those guidelines as such. Like you do the actuarial valuation of the retirement benefits, the similar accounting assumptions are made while you do the financial statement. But remember that these are complex. There are Black-Scholes formula, and there are various other formulas that you take into account what compensation hit that you take on the P&L side, and you need to get the merchant banker valuation done every 6 months while you are looking at valuing the ESOP, to take on account what is the charge that you will take in your P&L on the basis of ESOP that you have put in place. ESOP management is something that is an important element. I'll keep that to the last, because that's something that is applicable only after the whole plan is put in place. So I'll pick this slide at the end. I'll explain what I meant to say. I'm going to now come to my last part of the presentation, which is on the regulations of which is applicable to the listed companies. Remember that what I spoke was valid for IPO'd companies as well, the listed companies as well, but was valid for non-listed as well. Remember that most of the companies that plan ESOP may or may not go IPO. But having been with a company which was a pre-IPO company which went IPO, one of the learnings that I have is that if you are already aligned with your ESOP plan, as what the SEBI talk about, your ability to navigate with SEBI at the time when you file the DRHP and the RHP and you go through the IPO process is that much simpler. One of the learnings that I had was there were many questions on the ESOP that the regulator had, rightfully so, when we reflected back in terms of what those questions were and what were the genesis of those questions. They were extremely logical, and you find that certain of those changes have now come in the amended regulation of 2014. When we went IPO, we were governed under 1999 guidelines, and remember, those were guidelines at that time and now have become regulations. And I'm sure we all understand the difference between what is guideline, which is advisory in nature, versus regulation, which is mandatory in nature as such. So the ESOP program under SEBI has also traveled a fair distance. We saw the last change and last amendment that came in 2017, and I'm trying to reflect in a easy way as to what these SEBI regulations mean. Remember, when you read those regulations, they are put in a very simple manner, but have a lot of ramification. The ramification are for two set of companies. One, who are expected to go IPO, and two, for those who have already gone IPO. Remember that people make most money when they have traveled from a pre-IPO stage to an IPO stage, because that's where the value unlocking happens. But SEBI regulations talk about both these set of companies, both these set of options where where you will essentially have a clarity in terms of what this entails. I can see one question. Would we get the presentation? Yes, this presentation is for public consumption, so you will get all of these slides. They are all open source for your consumption. What is the procedure to set up an ESOP for a private limited company? Very simple process. The board has to pass a resolution followed by an ordinary resolution to be passed by the shareholders, and you are eligible to set up ESOP. If you want to do any variation, obviously the variation has to be not adverse to the employee. It can only be benefit of the employee. Then you have to pass a special resolution at the general meeting. But otherwise, for private limited company, we are talking about both resolution followed by ordinary resolution, and for variation, a special resolution. For a public company which is listed or non-listed, we are talking about a board resolution followed by a special resolution. Remember the difference. In a private limited company, only an ordinary resolution. In a public company, we are talking about a special resolution. And you are looking at special resolution by all employees to grant ESOP to the subsidiary company employees of the holding company, or granting of 1% of the issued capital at the time of grant. Say, for example, if you want to issue more than 1% of the stock option to any person, then at that point in time, you are looking at getting a special resolution, because not the law says that shareholders need to approve, and super majority needs to approve. If for some reason you want in a financial year to issue someone more than 1% of the issued capital as ESOPs. Obviously, to say, listed companies need to comply with SEBI regulations, which means that if you are in a direct plan and you are making issuance to employees, eligible employees, under the SEBI regulations, at that point in time, you need to do a complete process for listing of those options. It is compulsory, but that process has to be followed so that those options which have turned into shares can be traded by the employees on the floor of the exchange once the listing procedure is completed by the company. Again, the SEBI regulation covers the four things that I mentioned. There is no specific mention of RSU, but take that RSU is a part of the coverage. We also talk about general employee benefit scheme and retirement benefit scheme, but those are effectively embedded in the first three variations that we saw. The important terms are as follows. The ESOP is actually ESOPs, which is Employee Stock Option Scheme. We talk about ESOP, Employee Stock Option Plan. Same thing, different words, but have the same meaning as what we understand. ESPS, Employee Stock Purchase Scheme, exactly the same thing that we spoke about. It could be either a trust-based or a direct plan where the company shares as they vest, in our exercise. We spoke about exercise, and the good news is ESOP very clearly defines what the exercise is. It also talks about the grant. It talks about the secondary acquisition. Secondary acquisition would mean acquisition of existing shares of the company by the trust on the platform of the stock exchange for cash consideration. It means that when the ESOP is being planned by a listed company and the shares are already listed, how do you make the secondary purchase to augment the shares in the ESOP trust? That's what the secondary acquisition is. And then it goes on to define what that trust is. It goes on to define what the vesting is as well, what we have already discussed. As I mentioned, ESOP regulations for the listed companies also are talking about direct plan and through the trust. Remember, if you are going to do a trust-based ESOP, you must decide it upfront, and it is mandatory when you are doing a secondary purchase, you must do it by way of a trust mechanism. When you are doing secondary acquisition and it's a trust-based thing, remember you cannot do it under derivative F&O program. That's not allowed. It's just a delivery-based, which means that you can only do a share-based program and not a derivative-based program. You cannot do more than 2% of the paid-up capital during, as a secondary purchase in a financial year, and you must hold these shares for 6 months. There are certain exceptions, but those are extraordinary circumstances, and obviously the insider trading regulations have to be followed to the T, which means that the promoter group has to be, and the key managerial personnel have to act within the framework of insider trading regulations while a secondary acquisition is being done by a listed company. Eligibility is something that we spoke about. In this case, you must remember that the independent directors have been excluded. Earlier, before the change came in 2014, the independent directors were allowed as a part of their compensation. And if you go back in time and read through the definition of independent director prior to these regulations coming into play, it clearly allowed ESOP as the means of compensation apart from the commission that the company is paid. But now it has been put to rest. Independent directors are not eligible for ESOPs. Promoter and promoter group people we spoke about, and the director holding more than 10% through any means also not eligible. Compensation committee is something which is unique to a listed company. Remember, listed companies are required under the stock exchange guidelines and under LODR to have a compensation committee, and compensation committee is to the fore on the ESOP, where at least 3 or more non-executive directors should form with one independent director a compensation committee who will decide and formulate the schemes and terms and conditions for ESOP. So compensation committee plays an extremely important role before it is presented to the board of directors and before the board presents it to the shareholders for its approval. The allotment process and all the modalities and the logistics are also done by the compensation committee from time to time under the plan which has been approved by the board and within the framework approved by the shareholders. Before I come to my final slides, these are certain important provisions. Just to recap, one is that there has to be a minimum vesting period of 1 year. I've spoken about it. That's the only place where there is a restriction. Otherwise, you have freedom to put whatever vesting parameters you want to put, as well as whatever pricing you want to put. But there is this restriction of 1 year period between the date of grant and vesting. Second thing is that under ESPS, which is a part of public issue, remember you can give options to people under the IPO plan as well, but the pricing has to be same for it to have no lock-in period. If the pricing is different, then there is a lock-in for the people who are part of the ESPS program. That's a very, very important step while you are planning for an IPO and while you are planning for an ESOP, marrying both these things together, or at least making sure that a decision is being taken after understanding what the nuances are is extremely important as such. Employee being eligible for shares, he shall not be called as shareholder until the shares are issued to him on exercise. Very, very important. Therefore, he does not have any voting rights, does get any shareholders right till he exercises that. There is no transferability on this, and they cannot be pledged, hypothecated as what we saw previous slides. Very important part, you cannot in the middle of the road go and make a change which is detrimental to the employee. You can make the change which will benefit the employee, but you will not make the change which is detrimental to the employee, which means that you have to create a plan and create variation which are beneficial but not detrimental. You start a plan, but the plan that you have created, the obligation continues, the final option is vested and exercised, and the plan is closed. The trustees cannot vote, as I mentioned to you, and this is specifically for the listed companies. For those which are unlisted or private companies, may and where there is a trust, the trustees can vote. The principle is more to do with the listed companies as such. And then there is a certain requirement of what the pre-IPO scheme could be and how it can grant shares, rather grant options under the same scheme after the IPO. Usually our suggestion to companies who are going for an IPO is that they must create a fresh scheme under which they should grant the options after they have gone public, and not use the existing schemes, because the requirements are very stringent and more often than not it becomes very difficult to comply with those things, but it is easy to create a new plan and then run with that. One compliance item is that a certificate from auditors is required to be placed that everything is being complied with under the ESOP plan, and then that's something which is to be placed at the AGM as such. Let me take the questions now, and I'll come back with the final slide if the time permits. But otherwise, these are more practical aspect of administering the ESOP, which is something that many companies secretaries in employment would do. Some of the practicing company secretaries will also do, but I'll come to that at the fag end as I make my closing remarks. I'll hand it over to you, sir, for the question and answer.
Yeah. Thank you, Vivek. Yeah.
Just as a protocol, will you be asking the questions? Go to the question box.
Sadly, sir, yes, that is the normal practice we follow. So you can, for the time being, you can close your PPT so that Biman can put up all the questions on Word file.
Yeah.
All right. Okay.
Devendra sir.
Yes, Biman.
Actually, I am now logging from my tab, so putting it will be a bit difficult for me.
So you can ask orally. That's not a problem.
Yeah.
I will put the questions. I am sharing screen. You keep asking. I am sharing screen.
Yeah. Thank you.
In 2 minutes, you start your question answers. I will share the questions. Yes, Biman, please tell.
Yes. Yeah.
Yes, Viman, please continue.
Yes, screen has not come.
Okay, okay. Till the time you can ask the questions from Q&A or chat box if you have.
Yeah, there was one question from Brijbala Batwal. In case of performance-based stock option grant to MD and whole-time directors, are companies mandated to give disclosures on performance criteria in notice of AGM? That is for listed company. And what will be the considered adequate disclosure?
That's correct. That's a very good question. Usually what we suggest is to not give this aspect to the shareholders. The shareholders usually should give the authority back to the board of directors and committee, and with that the flexibility remains with the board to decide. Otherwise it becomes a very watertight program which is very difficult to navigate at a later point in time. The broad contours could be provided with the flexibility to the board to navigate within those contours. The shareholders give authority to the board. That would be in the right way of dealing with it, providing the flexibility, because remember, this is a long-term plan and requires flexibility. Also, that you cannot be detrimental to the employees, and the process for making a change and variation is pretty harsh, and therefore a flexibility is what is most recommended.
Okay. Okay. Yeah. Next question, Vivek, from Mr. Same Brijwala only. Cash settled stock appreciation rights are not regulated by Companies Act. Should Companies Act still follow ESOP guidelines for SAR, like taking shareholders' approval, this minimum 1 year vesting, etc.?
That is correct, because the underlying aspect is ESOP. Underlying aspect is stocks, and therefore, in all fairness and in the spirit, one must follow the process of doing the board resolution as well as the shareholder resolution while you take it forward. Remember, if you are using this more as an incentive in a different way, there are ways and means where you can carve it out. But in a private setup, if you are following the process, it is most recommended.
Thank you. Then another question from the same person. Can an unlisted company put a condition in its ESOP scheme that vested option can be exercised only after listing on liquidation events like PE investments?
Yes, it can do that, and we have been recommending to a large number of our clients to put that, so that there is no undue pressure on the company to get to the IPO or a liquidity event from the employees whose stocks have vested. Remember, they are paying for it, and therefore there is a pressure on the management, and therefore this idea of IPO or a liquidity event trigger for exercise of the option is recommended.
Okay. Then again a question, in case of performance-based ESOPs, can companies say that only vested options will be allowed to exercise by legal here in case of death if employees before 100% options vest?
That's correct. So that the company, in terms of how they would want to position their plan, many plans have vested options being eligible to be exercised within a defined period of time by the legal heirs. Many companies would also allow unvested options to be exercised as well. So, both cases are possible, and we have seen, both things happen. That's a flexibility and freedom given by law to the employer to decide what it would want to, in the ESOP plan that it puts in place.
Yeah. And next question is, can companies grant ESOP to trust, as trust is not eligible employee?
No. The trust is just a holder of the instrument, and the trust cannot benefit itself. So that would be contrary to what the requirement is. The trust is just mere holding body, and it's just incubating that particular thing, and that's just an implementing entity, and it can't have ESOP to itself.
Okay. The next question is connected with trust only. For listed companies under SBEB, how much percent can a trust hold? And they further, can you please elaborate on primary and secondary acquisitions?
Right. So it is either 2% or 5% depending on what scheme you are talking about under the secondary, under the SEBI ESOP regulation. The primary and the secondary is whenever something which is existing, which is bought by the company and put under the ESOP would be called as a secondary. Whereas when you have a direct plan and where shares are being allotted, when someone exercises its vested options, that will be termed as a primary allotment. That's the difference between primary and secondary. Primary is something where new shares are being created. Secondary is when the existing shares are being purchased and put under the ESOP trust, under the ESOP program.
Yeah. Thank you. That's the closer of Brijbala's Batwal's question. Next is Shobha Shetty's question. She has raised post-vesting date if the director entitled for ESOP on the vesting date resigns, giving 3 months notice period, can he exercise his option and claim the shares?
So it depends on what your plan is. If your plan says that whatever has been vested on the day of notice or the effective date of exit, it all depends on how your plan is written. The law doesn't prescribe anything specific. You could essentially, till the time he is a director, he would be eligible for the options which have got vested in him for him to exercise. But it depends on how you have written the plan. Many a times during the notice period, you may not want anyone to exercise anything or anything to vest. You take exit as soon as the notice has been given. So it all depends on how you would write your plan.
Okay. The same connected with this question only. Do the same rules of vesting apply to stock appreciation rights equally?
So the stock appreciation right would have two ways in which you look at it. One is something what you call as stock based and one what you call as cash based. All the compliances what are required to be done under other plans have to be done for SAR as well. But it all depends on what are you exchanging. When it is a listed company SAR, the company may have to sell the stock in question to realize cash and to pay to the employee, and therefore it has to follow the process as required under the SEBI regulation, also the insider trading regulation, both looked in tandem. And if it is issuing new shares, then it has to follow the stock exchange guidelines to list those shares what has been issued under the stock appreciation rights.
Yeah, thank you. Next question is, what do you mean by separate resolutions for grant more than 1% of paid up share capital of company?
The requirement is a special resolution. It is because the logic is very simple that, ESOP is a small program, and if you are giving someone more than a certain percentage, then the shareholders must agree to that particular thing. Otherwise, there could be a situation where most of the options are being observed by a single person or two person, and that's not the whole idea. The idea of the ESOP is a broad-based one, but if the shareholders agree, then there should not be a problem. The shareholders, majority, super majority, this is special resolution. Therefore, super majority are saying that, we are okay giving, 5% of the total company to a particular person because he's so key. He's a CEO, he's a CO, he's a CXO person. So we are okay. Then that should be allowed, not at the ordinary resolution level.
Yeah, thank you. Next is, while vesting, can a company vest all the options at one go?
Oh, yes, they can do it, provided there is a 12-month quarantine, as we say. Till the time you follow that 12-month, all the options can be vested immediately upon completion of that 12-month from the grant date.
Okay. The next is, at the time of exercise of option, if the price of the share in market is low than the ESOP price, in that case, what steps company can take or should take?
There are two ways to look at is that, many a times we call this as many a times you have a situation where these are underwater options and none of the employees will effectively exercise them, right? Because you don't want to pay for something which is not making money, and therefore this is called as an option. But if the company continues to want its employee to make money, then it can create a new plan under which the pricing of the options are such where people can still make money. To give you an example, in the existing plan, if the price of the option was 50 rupees and currently the market price is running at say 40 rupees, no one is going to pay 50 rupees to buy a stock of worth 40 rupees. But what the company can do, company can create a new plan, issue the options at 10 rupees so that people see a value in it and they can still continue to exercise when they vest. Remember that two things will happen. The current options may lapse under the old plan, and the new plan will take its own new course, which means that 12-month window of vesting, etc., will start, and that has to be run in a separate course of time. But still, companies do it just to make sure that if the employees have to benefit, then the only way to do is to stop any further grant from the new plan and create a new plan and give them a fresh, assuming no one will exercise from the old plan in itself.
Yeah, thank you. Next is there an exhaustive list of factors that a company should consider while planning the issue of stock options?
So, there is no exhaustive list. What we usually do is we have created a detailed questionnaire and we send that questionnaire to the client and expect him to fill that for us. And then we discuss that questionnaire threadbare. With that, what happens is all the possible options are discussed with the client. And on the basis of an agreement with the client on that questionnaire, the drafting can start. As you would have seen in my presentation, there were certain questions that I put forth. Those are major questions. Obviously, there are more than that questions that you will find. They are relevant, and therefore you will put those questions to the client, discuss with the client or management, as the case may be, and then start drafting. That's a very involved exercise, Biman.
Yeah, thank you. Next question is, if options were earlier issued at face value and then the company issued bonus shares, then how to make adjustment in price for new options as the shares can't be issued below face value?
Correct. So bonus shares is just a balance sheet adjustment, right? So you will have less of reserves and more of the share capital. So the balance sheet remains the same. It's just a shift from one to another, and therefore the price adjustment is automatic mathematically as well as the number. So effectively the value mathematically remains the same, and therefore, as I mentioned, the benefit of bonus is granted, but the price will also get adjusted. For example, prior to bonus, if the price was 10 and there is 1-to-1 bonus, at that time the price of the granted option will become 5 and the options will double. So mathematically, you have now 200 options of 5 rupees, making it 1,000, whereas you earlier had 1,000 of 10, making it 1,000. So, effectively it's the same thing. You are just breaking it for convenience sake, but, it would not be detrimental to the employee. He's not paying 10 rupees, he's now paying 5 rupees, but has double the shares because of the bonus as compared to pre-bonus.
Yeah, thank you. Next question is, which all registrations are required for employee welfare trust? Is it a revocable or irrevocable trust?
Very good question. So I think, it could be both revocable and irrevocable. We suggest that it should be revocable because this plan is not a permanent plan. It can get over, and if you have, certain things, which is, cash lying in that, you might want to use them and not make it perpetual in existence. So, it should, on a practical basis, a revocable trust, but it could be a irrevocable as well, practically, rather theoretically speaking. And, you don't, this is a private trust, you don't particularly need to register, but because it is a trust and a separate legal entity in itself, you have to do all the income tax filing, build the balance sheet, and what have you. So you would take a PAN for this particular thing, and depending on your particular company situation, you may have certain other registration required. But PAN is a minimum. You need to complete your balance sheet, which means you need to have an audit of that done and stuff like that. Therefore, our recommendation has been that unless there is a secondary element and unless there is a real requirement, think hard whether you want to create a trust-based ESOP program which has this maintenance cost as against something which is a direct plan. That's just a practical way of looking at it.
Thank you. Next is connected with trust only. Does trust needs to have a shares in its kitty before making grant of option to employees?
My answer to that is yes, because if at a later point in time, say for example, I am a trustee, I'm supposed to complete the logistics of the whole program, and at that point in time, you are looking at a situation where there are no shares underlying. At that point in time, there could be a precarious situation where there is no underlying security, but there is a obligation on the company. Therefore, unless there are shares, we don't recommend using the ESOP program as such under the trust mechanism. So the trust should hold the shares, and then the ESOP program should be rolled out to avoid certain practical situations that may arise. Certain companies take chances and nothing happens to them. But we never thought COVID will happen as well, right?
Yeah. Next is how RSU are different from ESOPs.
So it's a terminology as such, Biman. It is not something where there is a specific mention in Indian law of RSU. RSU is slang, if I will, and this slang is only to differentiate between a restricted stock meant by a specific reason where you are discounting the price to a level where it is virtually at a face value, is being given by listed companies more often than not, but at a very, very low quantity, because as I gave an example of Wipro, which was running at a very high price but gave RSUs at 10 rupees effectively, or virtually at a no price to the employees. People are in money immediately. Unlike that, in ESOP, you are pricing the ESOP either at a book value or near to fair value, and therefore the grant is for a larger number, and the conditions are different as compared to RSU. Also, RSU is given to select few people, and the conditions to meet are stringent. And more often than not, the CXOs are given these things in a growth sustained scenario in companies.
Yeah. Thank you. Next question is, in case company grants shares in 4 years, if it does not vest shares in first year, then whether those shares can be vested in second, third, or fourth year along with proportionate share of that year?
It depends on how your policy is worded, Biman. So it all is policy driven. You might want to word your policy exactly in the manner you would want it, or you could also give the rights to the board to decide on case basis how you would want the vesting schedule to be. But honestly, we don't like too much of freedom to the board, because the management becomes very difficult when the number suddenly increases, and therefore the best way is to put method in madness and document what is your policy on the vesting. As you define vesting, the ESOP would run exactly in that manner.
Yeah. Thank you. Next question is, in case of listed company, market value of shares fall below face value, then whether company can issue ESOPs below face value? If yes, then whether company existing scheme can be modified to revise ESOP prices?
So anything that is benefiting the employees as a variation subject to a special resolution passed at the shareholder meeting can be something that the company do, not anything which is detrimental to the employee. So in this case, if it is going to benefit the employee, then subject to following of other regulations under SEBI, under Companies Act, you can still do it.
Okay. I think there's a basic question. Please elaborate as to how derive fair value and intrinsic value in case of ESOP.
Okay, so the fair market value is essentially the valuation that you get from the merchant banker every 6 months. And the reason you do it is to have a clarity as to an independent person valuing when you are, not a listed company. In case of a listed company, the pricing guidelines come into play, and which is very clear. But for a non-listed company, the fair market value is what the merchant banker provides you. The intrinsic value may not have significance unless you want to play that from the grant price standpoint. The exercise price has to be determined vis-a-vis fair market value to calculate the perquisite tax.
Yeah. Thank you. Next question is, what is the maximum percentage of authorized paid-up capital which can be granted as options? If the company is having 100 shares as authorized share capital and 50 shares as paid-up share capital, how much maximum ESOP can be granted by company and for approval?
So there is no maximum limit as such which the law prescribes. The law only says as to what you need to do while you give more than 1% in a financial year to one single person, and what is the process to be followed. But you may want to allocate, a lot of shares to the ESOP program. Generally, as I said, what we see in India is 8 to 10% of the shares being allocated. Maximum you have seen is 22%. But the law prohibition, I'm not too sure there is any.
Okay. Next question is, can ESOP options be given to the promoter, relatives of promoter, but also director and also shareholder of the company?
No, not in a listed play. In a unlisted play, if you are a startup company, then obviously certain eligible startups, if they continue to, at every stage when the allotment happens, they continue to be startup under the DIPP guidelines, then they can, but others cannot.
Okay,
Post 2013 guidelines.
The next question is, can the vesting period be more than 12 months?
Oh, yes, absolutely. 12 months is the minimum. Maximum is something that you could prescribe. The 12 months, please understand that 12 months is the minimum period. So you can't have 6 months, you can't have 9 months, you can't have 11 months. You can have any period more than 12 months for it to be a valid plan under law in India.
Okay, thank you. Next question is, can company vary ESOP terms if detrimental, when detrimental, with consent of employees by giving them some other alternatives?
No, you can't do it. You can't, shake hands with employees and, create a same plan variation which is detrimental to them. The best way is to close that plan and, close the plan in the sense, decide that you will not make any further allocation. And as I gave answer to the previous question, create a new plan. In that plan, as you would expect the employees to benefit, create that plan which would benefit them, and then run that new plan as if you are running the old plan so that the employees benefit. But you cannot, even with the consent of employees, change something which may or may not be, which is absolutely detrimental to them. You cannot do it.
Okay, thank you. The next question is, what happens when the employees leaves the company after exercising the ESOP? Can the company buy back?
Yeah, so if your plan provides for a very clear situation where while the employee is leaving the company or is terminated, at that point in time, he must compulsorily sell it to the designated, either it could be to the trust, or it could be to the promoter, or it could be to the nominee of the promoters. You could make that particular statement in your ESOP plan and make that binding on the employee. so that he doesn't go out of the company with the shares if you're still a private company as such.
Yeah. Thank you. Next question is, what would happen to the dividends on the shares held by trust?
So the trust continues to get that dividend because the shares are being held by the trustees of the trust until the time it becomes shares. Remember, it's an option, right? So you may choose not to exercise that till the time the shares are rather the options are not converted into shares. The trustees of the trust will receive the dividend, and that is of course to be applied in the interest of the employees, but it is not to a specific employee asset.
Okay. The next question is, at the time of issue of ESOP, after exercising, whether company need to follow the entire process of allotment of shares?
Come again, sorry, I missed you.
At the time of issue of shares, issue of ESOP.
Yeah. Yes.
Issue of ESOP after exercising, whether company need to follow the entire process of allotment of shares?
Oh yes. So if it's a fresh share, it's a primary issuance, then obviously all the procedural aspect of allotment have to be completed, whether they are of ESOP or otherwise. So shares emerging out of ESOP also have to follow the same process as what you would do for other things, including for the listed companies, listing of those options. So that is a cumbersome task for the listed companies, but if you are a direct plan, then you will have to do it. If it is a trust-based, the trust-based shares are already listed, then those don't need. But if it's a fresh share issuance of the listed company, then you need to follow allotment as well as the listing compliances.
Yeah, thank you. Next question is, further, what will be the status of shares which are not exercised by the employees?
They lapse and they come back in the kitty of the company to reissue. So, if you don't exercise within the time frame what is allowed under the plan and you choose not to do it, then they will lapse and your right over it will go away as employee, and they come back in the kitty of the company to be reissued.
Okay, thank you. Next question is, in your opinion, which is the better method, direct or pro trust board?
So there are pros and cons. There is no yes or no answer to it. It depends on what stage of the company you are in, whether there is a secondary or there is only a primary, which means that if promoter are going to gift something to the ESOP or someone else is going to gift something to ESOP, then obviously for holding that you need to have a trust. There is no other mechanism. But otherwise, you need to choose direct versus trust mechanism on the basis of your situation, and also looking at what is the maintenance cost associated with running the trust, and are you willing to look at it. For example, if you are giving it to only 10 people, only 15 people, then practically speaking, the expenses of maintaining trust and everything else does not justify that, and you would want to look at a direct plan as against a trust. But there could be a specific situation in the company for which a trust has to be created even for 15 people allotment or grant. At that point in time, the reasons could be different, and therefore it's an individual answer on each situation. Of course, you will weigh money and maintaining of the trust before you take a decision whether to go direct versus trust route.
Okay. Yeah, thanks. Next question is, law mandates all options to vest in case of death of an employee. Can company make any exceptions to this?
The company, so there are two ways to look at. Whatever is vested becomes the right of the person, and beyond him, the legal heirs, stand in his or her shoes to exercise those rights, right? And you cannot take it away as such. Having said that, what do you do for the unvested is something that a company can decide. Some companies also allow the legal heirs to exercise unvested, which means they accelerate the vested options in the hands of the employees, legal heir, should there be unfortunate death while he was an employee.
Okay. Okay. Next question is, in case of more than 1% of paid up capital, is the existing shareholder of employee is entitled in limit?
No, so this is purely on the ESOP plan. So, say for example, he has been granted ESOP of more than 1% of the paid up capital at the time of grant, then the process needs to be followed, not otherwise.
Okay. Then next question is if an option once vested with an employee but not exercised, can the option be granted and exercised by the same employee in future as and when introduced by the company?
So, each option is unique and it will run its own course. So, say for example, if it is vested and not exercised and the time is gone for exercise, it will lapse. Now, if it is reissued to the same employee, it will run the same test again. And, that 12-month vesting or the vesting schedule, if he gets that, then obviously, he can exercise it. But it is not automatic as such. It is based on what the policy prescribes, and therefore the policy has to run its own course for the employee to exercise again something which he had not exercised before. That option is gone. The next thing will run its own course. It's a fresh running of 100 meters. He can't say that I ran 50 meters. Now I'll only run 50 meters and still win the gold medal.
Yeah, that's connected with the same question, I think. There's another question. If the options are not exercised in the given period, whether the period to exercise option can be extended? And if yes, by what time further it can be extended? And if necessary, to pass a member's resolution for the same?
Yes, because it's a variation, but it is benefiting the employee and it's not detrimental. You can do that and extend that time frame as what you and the shareholders think appropriate.
Okay. Okay. Next question is, can company charge option premium during granting of ESOP?
Yes, it's just the price at which you give. For example, if you decide if your price is 10, the book value or the fair market value, and you want to issue it at 20, you can still do it. But that's not how ESOPs work. While theoretically the answer is yes, but you will not do it because the ESOP is meant to benefit the employees and not just for the theoretical sake. So my answer to that is yes, you can, but you will not.
Thank you. Next question is, in case of drafting a plan, employees' view or company's view to be made priority?
That's a good one. I think, it has to be a win-win situation. Otherwise, this does not, see, this is not a fight between one versus the other. It is together, right? So, the employer is genuine, unless the employer genuinely wants the employee to succeed, okay, then only the plan becomes successful. If you are giving, but you are not giving, then it doesn't work in that manner. Then these plans have got no meaning. Your idea has to benefit the employee, but with the checks and balances, right? You are not expecting, therefore, the plan has to be strategically drawn with a very clear intent that the employee has to win. If the intent is not there, the plan will not be successful.
Okay. And then the most important question, what I feel among all these questions, is that everybody has requested you to mail your PPT. So I think the head of will take care of that, and in that way, questions of most of the members will be resolved, which we could not take it today. And with this, I'll now request Deepak sir and Devendra sir to please carry on the next thing.
Thank you, Biman. Sadle sir, thank you. Thanks a lot. Actually, we are on the last session of the first crash course of ICSI. So, Biman, we wanted you to be also present for this concluding session. So, just a second. I'm just requesting Manish to get in. Manish, are you there? Deepak is there?
Yes, I'm there.
Yes, I'm also there.
Yes. So basically, first of all, I would like to thank these two gentlemen who have been really a backbone of these courses, and they have really been working day in and day out and with the team. And Nikhat ma'am and Banu ma'am, they have been working along with their teams to make this entire course a successful one. Security laws was the first thing which got into our mind when me, Manish, and Deepak were discussing. So this was the first course which we thought about, and this is the first course which we are concluding. And I'm happy to note that highest number of participants we have got only for this course. So even though we have crossed on an average 225 in every course on an average, but this course has seen 303. So the highest number of participants were there for this particular course, and I'm really happy to mention that. Just to brief that this entire course started with the session from Kalidas Ramaswamy on board processes. It was a wonderfully narrated session. Then after Narayan Shankar's session, nobody will forget, because it had got lot of case studies, live examples on insider trading. Shailashri Bhaskar ma'am, she spoke about SAST, and that was also a lot of practical issues were discussed in the SAST related matter. Savitri Parekh ma'am, she talked about LODR compliances, how to do secretarial audit, how to face secretarial audit, and so many nitty-gritties of LODR. And the last but not the least, Sadle sir, who has been my mentor as far as ICSI work is concerned, as well as I have been looking at him as a company secretary since my studenthood, and he concluded it wonderfully. The number of questions we got for this particular session itself says that the session has been wonderfully heard, understood, and people are really interested in this particular session. So at this point of time, I would like to just give thanks to all who have supported me in this endeavor, and the team of Deepak, me, and Manish. It will remain as it is for further courses also, and we may come up with additional courses or couple of repetitions of such courses. So security law again will be again a session which, or a course which can be repeated due to the number of people who are interested. I'll just request Manish to just conclude this by informing about the assessment tests, recordings, PDFs, everything. So Manish, over to you. You can just give your remarks in respect of LMS and tests and PPTs.
Thank you, Deva bhai. I- in this and crash courses for our members. And then we all started with this. And all the study material, PPT, and all other material would be available in the development system of the institute, which is a unique thought process of ICSI, wherein you can find all the learning material at one place, and your assessment would also be at the same LMS portal. You all will be getting your dedicated password and links for the LMS portal connectivity. You can all visit there. Your PPTs are already there. You can access them anytime as per your convenience. Your assessment would take place on, I think, 15th or 16th of this month, and for 1 hour examination. And these questions are prepared by the faculties only. Whatsoever they have taught you, whatsoever they have given you the words of wisdom, the questions are based on the sessions only, and every question would carry 2 marks. 50 questions. Every question would carry 2 marks, and the passing percentage would be 50. And thereafter, we would be having a ceremony for the issuance of certificates from the president's hand, and that would take place anytime after 15th or 16th of May. For all courses together, we are planning a mega ceremony for thing for all the 4 courses jointly after the assessment is completed. So all the best to all the participants, and many thanks for your participation. Your participation will always motivate us to plan more such programs for our members. Would like to thank Deva Bhai and Deepak Bhai for planning this crash courses, and for wonderful arranging the faculties, and for all the things we have done. My thanks to the entire team of IT, led by G. Banu, who is heading PMQ committee, and then the entire team of Banu, Sameer, and Nikhat for marvelous team and managing. Thank you all. Over to you, Devendra bhai. Deepak bhai, you may initiate now. The final.
Deepak, your last word.
Okay, thank you, Devendra bhai, and thank you, Manish bhai. After all good things and the detailed thanks which both of you have given, this includes me also, so I would not add on. And this has been the beauty of the program, that it was conceptualized in a very short minute. And while we were having the PCS committee meeting, and instantly the 3 unique things, like Manish ji is sharing the PMQ courses, and then Devendra ji is heading the CCGRT. So we 3 then instantly came together to pull all the resources possible. And when we started, we had actually never thought that we could actually successfully complete it in such a way. And every day after the program and before, we are constantly in touch with the faculty and the way the systems will run, and we are evolving every night. It is like that first time we are working back end like online technicians, and we really enjoyed this experience. And the way all of you friends have come forward has been really encouraging for us, because that is our only satisfaction, that there has been high registrations for this course. And the second satisfaction will be when all of you will pass this course and you will get your certificate, and we will put up and share with our friends and family that we have done something good in the lockdown, and utilize this time for a constructive work, and not only in WhatsApp or otherwise. So thank you so much, Manish bhai and Devendra bhai, for coming together at such a short notice. And in fact, to be very honest, I was assisting both of them in carrying forward whatever little bit task which I got, and I really enjoyed and learnt a lot. And also thanks to all the moderators from team EIRC who have joined together at a very short notice, especially to Biman, who accepted my request yesterday night and today morning. And now over to you, Biman bhai, for formal vote of thanks to the speaker of the session today.
Yeah, I think Manish sir wants to say something. I just raise your finger.
Yeah. One more thing I just would like to highlight, that from the PMQ courses, we are coming out with 2 more courses for our members. One is for the women directors, and another is for the POSH. And would request all the participants, whosoever is willing to have more knowledge on the nitty-gritties of the POSH and the women director, what are the role responsibilities, how to deal with the situations, practical situations. Registrations are open till tomorrow, 12 o'clock in the night, and would request you all to kindly see the brochure, and please enroll yourself for that those courses as well. Thank you. Over to you, Vimal.
Yeah, thank you, Manish sir. Thank you, Deepak bhaiya and Devendra ji. I think there were 2-3 questions again regarding the process how to log in the LMS portal. So I will request Deepak sir and then to please guide the members on this, how to log into the LMS portal.
All the details will come over the email. All the delegates who have registered, who are participating here, will get a detailed email as to how to log in the LMS portals. All the videos have been recorded and all their links are now available. because we were all doing on a lot of trial and error basis, so we were not very sure. But since from the beginning we were telling you that the recording process is on, and those videos will also be put up on the LMS portal. So you will the steps will also come in the email. So just log into the LMS portal. You will have sufficient time to study. Today is only 5th, and the exams will be on 15th and 16th, and so you will have 2 attempts also. So there will be no problem at all. Just devote your time in learning more knowledge. Yes, Biman.
And there is also one link which will be provided for giving feedback, so that we improve in the next crash course. So your feedbacks are most important, and you may please give the feedbacks as per the link given in email. Thank you. Over to Biman for the concluding remarks.
Thank you, Deepak Bhaiya. Thank you, Devendraji. Now it is the most important and the priority task of giving the vote of thanks to today's speaker. I thank Vivek for sparing his time and doing all these preparations and giving whatever he has gathered in so long tenure of his experience and sharing it over a period of 2.5 hours. It's really a mind-blowing job done by Vivek. I thank you, Vivek, from the entire team of the ICSI, from the Eastern India Institute of Company Secretaries, and from all the participants for giving us a detailed understanding of these laws. And I hope all the members have understood everything in that. And since in most of the part of the country, the lockdown is extended till 17th of this May, I think everybody will clear it off, because stay at home, be safe, and only do your studies. With this, thank you everyone, and thank you all. Be safe, take care. Thank you.
Thanks everyone. Thanks, Devendra.